Welcome to That Annuity Show, the podcast that will make you an expert in explaining annuities to your clients. Give us 30 minutes each week and we'll shave hours from your client presentations. Now, here's your host, Paul Tyler.
Hi, this is Paul Tyler, and welcome to another episode of That Annuity Show. And we got something special for you, but I won't. I'll hold off for about 3 minutes on the surprise here. Mark Fitzgerald, how are you?
Paul, I'm doing great. How are you?
Good. Summer's coming to close quick.
Sure is.
More time. Well, last week or two of summer. What are you doing? Boat? Is that the plan?
Going to try to head out on the boat this weekend. Head out to Montauk.
Okay. Will Moorcroft, you doing anything with your CrossFit buddies here to?
No, just winding down the summer, and my kids don't want me to talk about school yet, even though it's coming fast and next week. But I wish I was joining Mark out off Montauk. I know there's a big bluefish tournament this weekend. But anyway, this is a highlight of my week. That annuity show.
Yeah, Ramsey, you picked a great time to have relocated to Atlanta. You missed the storms in New York.
Yeah, loving it down here, although my allergies are killing me. So other than that, it's great.
Yeah. All right. Well, what's special this week? We actually have our first guest host, Mr. Bruno Caron. Bruno, how are you?
I'm very good, thank you. How are you?
Thank you. Hey, terrific. Thanks for joining. We had a great discussion with you. That was time flies. That was maybe 3 or 4 months ago about your book that you just released. We'll talk a little bit more about that. But with that, do you want to introduce our guest for the show?
It would be a pleasure for me to do so. So today we have Jerry Golden, who is a very interesting person, has worn many hats. On the distribution side, on the product design side, as well as on the regulatory side. He's an actuary by trade, has held some very senior roles at AXA and Mass Mutual, and now he's running his own retirement company. So Jerry, welcome to That Annuity Show. So
thank you. Thank you.
So to kick things off, I've read a lot of your publications, your blogs, and of course, as an industry, we always talk about saving for retirement. We always talk about asset allocation. Asset allocation is an academic term that is widely used. We talk about asset management being an actual industry. Well, you take it a step further and take all of those terminology and apply them to income management, income allocation, and really look at that particular angle that most of the industry doesn't necessarily pay enough attention to. Can you describe and elaborate a little bit your train of thought and how you believe income fits into the entire retirement picture?
Great. Thanks, Bruno. Well, it sort of starts out, what's the market? And the market, are baby boomers and baby boomers who are mass affluent. And the strategy you talk about of asset allocation, most advisors have said if asset allocation works pre-retirement, it's going to work post-retirement, and that may be true for the high net worth person. They can live off their dividends and interest and so on. That asset allocation does not work for the mass affluent baby boomer. And their number one concern is running out of money in retirement. Just to get a picture of the size of that market, mass affluent baby boomers, think Canada. Same number of households, same number of individuals. So it's as though you're going into Canada and everybody is between 55 and 74. And they have a give or take between 500,000 and 3 million of savings. So they're concerned about outliving their income And so we simply said, let's not turn it on its side, but let's, rather than look at asset allocation, where is their income going to come from? It's going to come from Social Security. It's going to come from any pension, whoever has a pension. It may come from part-time earnings. It may come from deferred comp. But for these individuals, they can't live on that, so the income has got to come from what they call retirement savings. And simply we looked at that situation and said, dividends, interest, withdrawals from IRAs, that's the typical plan. But there are other income sources that to me are obvious by an actuary coming from the insurance industry. One are annuity payments. I mean, that's a pension, but it's issued by an insurance company. And that drawdowns from the equity in your house is another source of income. And I know from the baseball analogy, if you're a 3-tool player, you're a pretty good player. That's dividends, interest, and withdrawals. If you're a 5-tool player, dividends, interest, withdrawals, annuity payments, and drawdowns from the equity in your home, by definition, you're going to have the better solution. So in any event, so we believe that focusing on income, considering these other income sources, and through a planning tool, we'll be able to deliver the better result.
No, absolutely, and you bring a really, really good point on the mass, the mass affluent. I mean, if you do take those particular strategies, and if, to put numbers out there, if you have $1 million of assets, I mean, I think it's a fair number. It's not probably potentially what it used to be, but it's still not nothing. $1 million of assets, if you translate that into the S&P dividend yield or where rates are at, you're going to live off, maybe $25,000 a year and leave the rest as a bequest, or you're going to at least at some point withdraw from that amount. And if you withdraw from that amount, that does cause some issues, especially on the longevity risk, as you mentioned. So. No, that makes perfect sense.
Sorry, one thing I see important, a lot of planning plans to 90, plans to 95. So we have a friend of my wife said, she was talking to her planner and said, my family lived beyond that, what should I do to make sure the income continues to 95? And the answer was, well, spend less. That's not a satisfactory, answer. And so, we have, as an industry, we have annuity payments. We sell those, those what we call income annuities. We're not in the reverse mortgage or home equity extraction business, but others are. So learn about that and see how that could add to the total. The solutions are there. It's just not necessarily a part of every advisor's practice.
So Jerry, I wanted to ask you about sort of what you see as the role of planning. So you and I have spoken a lot over the years, and the thing that certainly I discovered on that journey was that there seems to be in many ways a planning gap. So in order to make the determination and answer the question of what the role of an annuity is, like planning maybe needs to play a bigger role in the education and the sale process that it has in the past. So talk about how you've built tools around that specific need.
Yeah, there are two parts. One is how we built it, and and how we deliver it to those advisors. How we built it. And my first assignment as an actuary was to price an immediate annuity, and God knows how long ago. And I thought then it was a very elegant product, made total sense, but it was driven primarily by the ability of the insurance company to invest its funds in mass assets and liabilities, and ultimately there was an interest rate that drove the amount of the income. And so when we think about our planning tool, we say, okay, this is just another asset class issued by a highly rated insurance company, priced with an underlying we call annuity crediting rate, and has this wonderful thing which Bruno mentioned, which is longevity protection. And so building the planning tool was, how do we basically integrate 3, then 4, then 5 asset classes, but looking at the optimization from the income perspective. And it's not only, as Bruno said, it is the amount. That is important, very important, but it also how much of that income is at risk. One of the other parts on the planning side, it's great to get the first plan, get you comfortable. But what happens when the assumptions don't bear out? The markets don't return what you think. So you could say, use Monte Carlo simulation and then take your chances. Our view is quite different. Create a plan, I don't want to get too technical, based on deterministic assumptions, and as the world evolves, update your plan. If there's a 20% market correction, I probably wouldn't have anticipated that in my Monte Carlo, so therefore adjust your plan in real time to reflect the 20% market correction. And if you have more of your income secure, that 20% market correction is going to have much less impact on your plan versus another. So basically, build the tool as you would, but income allocation, and treat that new asset class. The other part is, how do you get advisors to adopt this tool? And this is something we're going to experiment with. The way we do it is we deliver it as part of a lead generation approach. We bring them prospects, do-it-yourselfers, who have used our tool on a much more limited basis and who have created their own plan. Therefore, their job is not to create the plan in the first place, it's to refine the plan that the prospect, lead, whatever you want to call it, has created on his or her own. So we're not going to be in the business of wholesaling financial planning software. To the extent we go to third-party advisors, it's in the business of delivering them leads who have used our tools and now need a refinement and now need an execution or implementation.
Hey, Jerry, how do the individuals find your tool? Is it something that they can access easily, and then once they've found you, you have their information, and then you kind of use that to generate leads? How does that work?
Great question. I asked my analyst to say how many visitors we've had to the site and how many people have ordered it. So we've had 60,000 unique visitors to the site, which is probably nothing, because we haven't adopted what you might call our social media campaign. So the way we generate leads is to partner with, in our case, a financial publication, Kiplinger's. And so we work with them, and so our thing is not quantity, it's quality. It's the do-it-yourselfer, and it's somebody who has created their own plan. Now, we don't always do what I would call holistic planning. We also do what we call programs, which is planning around a single saving source like an IRA. So the question they ask is, what's the most efficient way to generate income from my IRA? Much simpler than how do I take all my savings. We also have campaigns around strictly annuity quotes and how can annuities, whatever. But as the moment, we haven't used a social media campaign to drive people to the site. They've found us in other ways. We work with partners like Kiplinger and other financial publications to develop leads.
Jerry, this dilemma with baby boomers, having the concern of running out of money in retirement has been going on for years. What do you think the biggest challenge is with advisors and agents kind of making that mental shift from an asset allocation mindset to more of an income allocation mindset? and how do we overcome that in your mind?
Well, this is a lesson I learned a long time ago. If I were in the insurance company and I had an idea for a product, I basically learned I can't convince everybody. I can only convince the people who are convincible. So basically, you set your sights at a number of advisors that you want to do is consistent. Now, AXA Equitable, we needed a gazillion to satisfy management. But as a company like ours, we don't need a gazillion. We need a few good men and women to do it. So find those advisors who, really are almost there. They do annuity business along with AUM business. We call them agent advisors, and they're just looking for something like this. And it'll take us a while to do that, but basically narrow down the universe of people you're looking for to those who are there and they just don't have the tools.
Yeah, Jerry, you alluded a little bit to work you did at AXA Equitable, and I know you've you talked about pricing an immediate annuity. Something's changed in this business. I would say a lot of things don't change in this business, and some things do. We're certainly going through massive change in terms of how to Mark's question. Advisors are finding customers. Where are the products going to head? I mean, if we were to fast forward, 5 or 10 years, how do you think the fundamental design of the products may or may not evolve? And who will be issuing these? More companies, same companies with different sources of capital. What will the landscape look like?
Yeah, when I started this business, I was no longer EVP or senior EVP for AXA Equitable. I was an entrepreneur. So basically I said, I have ideas for product innovation, but I'm not at the insurance company and I'm not going to try to sell up the food chain to this. So basically I said, I'm going to take existing products, if you will, and the income annuity is 100 years old, and hopefully insurance companies will price it aggressively and so on. So our approach has been, as I've said, is how do we integrate a pretty standard product and make it better. That is, we don't make your retirement, we make it better is a little slogan we use. So to be honest, I'm not really paying a lot of attention to the so-called innovation in the insurance business, because, to be honest, the last thing we want to do in this planning process is to put a fire out of some good or bad critique from somebody who doesn't know the industry or have some story about a product. It's not necessary. If somebody made me president of XYZ insurance company, what would I do tomorrow? Well, I'd look at my product lineup. I'd look at the rates of return. I'd look at the risk. I'd look at the market, and I would. I have some innovation. I actually, in my world, I would think there's some natural innovation in the annuity payment world. I'm not in the index annuity world and no longer in the variable annuity world. And I would just make sure that we're doing the right thing, and whether that in turn is the right long-term strategy for the company. But unfortunately, I don't have the crystal ball because I haven't been really paying attention to the so-called innovation at the insurance companies.
So, Jerry, if you're looking at the mass affluent market and looking at the numbers you mentioned earlier, the 500,000 to 3 million in assets, do you have any standardized rule of thumb as to what percentage of their income should be guaranteed?
Great question. So that's what the tool is. Now, our philosophy in terms of questions we ask of the client. Remember, the first exposure is the prospect, not the advisor. So we never want to ask a question of the client they can't answer. That is, how much, to answer that question. We want to ask them questions that they have the basis of. We ask them, well, low, medium, and high, what's your long-term outlook on the stock market? Low, medium, and high, what's your risk tolerance for allocation to, stocks? What's your, low, medium, and high, and what's your concern about in inflation? And then one other question, and this is a soft question, but we found it important. Are you somebody who needs the most amount of income and are less concerned about legacy? Are you somebody who just wants to beat the interest rate and really just want a fair return and put it in legacy? Or are you balanced? Never ask them about how much would be guaranteed or how much annuity payment, because they don't have a clue, nor does an advisor. And from that information, our algorithm basically comes up with a low, medium, and high allocation to income annuities and annuity payments. Having done that, when we bring the advisor in, and I can tell you all my secrets, we make the advisor a hero, because now the advisor can help and make a more informed decision as to the allocation to annuity payments, and can add large amounts of value. The client, it's unfair to ask the client. It's not unfair to have the advisor come in and refine the client's, or at least our conclusion as what the client was assuming. So we like our set of questions better than, you take your stairs 3 at a time or whatever softball questions on a typical advisor thing. We hope our questions are helping to create a plan, but for the most part, it's the first cut at a plan. It's not the plan.
Hey, Jerry, quick question on that. What you mentioned earlier about these are do-it-yourselfers or people that have already kind of done their own plan, and then you're working to transition them to an advisor. How does that work if someone's been more independent-minded? Are they willing then to be engaging with an advisor after they've kind of been in the do-it-yourself mentality?
Hey, great question. I've worked with well over 100 people, and they're all types, but they are one way or another do-it-yourselfers. In the typical process, let's say the client has $2 million of assets, and the plan, and again, we don't define a plan by the allocation percentage to annuity, how much would be annuities, but let's say hypothetically, 700,000 of the 2 million would be allocated to income annuities and 1.3 million to investment portfolios. Their do-it-yourself is more likely, almost by definition, around the AUM portion of the plan. They say, I manage my own money, and I do this, and I have ETFs, and I do this, and so on and so forth. And the advisors say, that's great. You can continue with that. We have some ideas, but that's a nice conversation to have. And maybe, growing older, you ought to think about, but they're not do-it-yourselfers with respect to knowledge about annuity payments. So if the worst thing that happens is the advisor helps them on a $700,000 annuity sale, and it's not one sale, it could be multiple sales, may or may not get a piece of the 1.3 million, and I hate to be too crude about it. It's still not a bad day's work. You've helped the client, and so on. So most do-it-yourself is around, and we've experienced, is around the AUM, not around the annuity.
Jerry, if you take a look at a client planning for retirement, you're looking 20, 30 plus years, and when you're putting together kind of their risk tolerance profile and their mindset in terms of what they're comfortable with, how do you prevent them from putting too much influence on the current market environment? Where obviously if you're in a long bull market, that might be much more cavalier and bullish in terms of what their trends and thoughts are versus a major correction. Their mindset might be too conservative for a 20, 30 year period of time. How do you kind of weed through that?
Yeah, I mean, we in our planning, and again, this is just the plan, And again, the important part is the world is not going to emerge like this, other than the annuity payments, the insurance. And by the way, it's nice to have the 700,000 payments, coming from that being assured. So first, we don't let them assume aggressive rates of return in our planning. Our low, medium, and high is 4, 6, and 8% deterministic. So they're not going to make their plan. Jerry, you're pretty conservative. I'd like to see the numbers at 12. That's not what we do. So we start out with our governors on the planning, and then we have this, and this is very powerful, is replanning. And so we say to them, let's say hypothetically we're wrong, or let's say there's a market change in 5 years. It's 25% up or it's 25% down. What did it do to your plan? And were you too aggressive, even with the 4, 6, and 8, or were you too conservative, and so on? And so we let them look at the replanning, result, or the market correction result. But basically, it starts off. We really start with put governors on the plan they're going to create in the first place.
Great.
Now, thanks, Jerry. That's obviously very, very interesting. And I'd like to switch gears to ask you a question on Ramsey's favorite topic. And let's just say that I represent the estate of a retiree. So I'm a brand new retiree, I'm 65 years old, and I represent the estate, the best interest of the estate. And there's a popular saying out there, I can't say that I agree with it, but there's a popular saying out there that says any lifetime income, any income annuities is bad for the estate for the very simple reason that you pay off a certain amount up front and the estate gets nothing at the end of the day. What are your views on that? What do you answer to that particular simplistic view?
Yeah, I mean, we have a tool, and I wrote a blog about that says, annuity payments are going to drive down what we call the legacy, what you're going to call the estate. And the answer is, doesn't happen. In the long run, by generating more income more efficiently. By the way, I haven't even talked about income taxes and what you've saved in income taxes. But we have a tool that says you're going to have a greater legacy, assuming a passing at a reasonable advance date, than you have if you hadn't elected the annuity payment. Now, if you're concerned that, if you pass away, tomorrow the kids will get less, that's true. That's the actuarial, trade-off you're making. But if that's your concern, then you obviously can manage the annuity by having beneficiary protection and so on and so forth. You can use the higher income to buy life insurance or whatever. But there is a trade, and if you're looking at the long-term legacy that you're going to be leaving, ultimately it'll be higher if you have the annuity payments based on all the analysis that.
And of course, that goes back to another very popular view in the industry, again, that I disagree, but there is that concept in the industry that if you have to annuitize, you have to annuitize your entire portfolio. And that I think that to this day, some people still think that, and I think that, correct me if I'm wrong, but I believe that if there's a balance for everything, and there's no obligation, and to take all of your assets to in annuitizing them, and to further it up, having a portion, to your point, into income annuities allows you to have more flexibility on the remainder of your portfolio, on the remainder of your particular asset classes. So I think that you have to your point, Jerry, you have to look at those particular scenarios. If I die early, if I die around my life expectancy or much beyond, And of course, the answer is we don't know that in advance. Just like when you take car insurance, you don't know if you're going to crash your car at the end of the year, at the beginning of the year, or not. So there's a trade-off, and there's unknowns there. So.
Yeah, and one other point, I think you sort of alluded to it, is that we've talked about getting more income from savings, that we can deliver that. But there's another way of looking at it. You can use less income, less savings, to produce the same amount of income. Well, if you do that, then you've found money for a more aggressive investing. So we don't discourage aggressive investing, but should it be as part of your retirement income plan, or should it be in your aggressive investing plan? So on the 2 million case, if I'm delivering the same income for $1.6 million as the competitor, then I found $400,000 for the more aggressive in investing. I just had a blog republished in Kiplinger, and part of it is making your plan less stressful. And should you look at the 6:30 news and they report what the Dow Jones did, and it's going to go down at some point, and you say, okay, that's nice, but that's affecting my more aggressive plan. My income plan we're fine, and that's our attitude. Just take some of the stress out of.
And that makes perfect sense. And as a retiree, you're also an investor. And number one rule, you want to be in a position of strength. You want to be in a position of control. And if down the road you are successful with those particular very aggressive investments, which you hope to be, you can change those, and you can change those asset allocation. But if you do it in a position of strength, that always works out better than some sort of 4% rule where you say, effectively, you're saying that, I'm going to sell some of those assets at a future point in time. That creates a lot of unknowns in terms of sequence of return, in terms of longevity risk, in terms of market risk, and the list goes on. So I think that makes perfect sense.
I don't know if there's a precise study. There must have been. People used to be happier when they had pensions. Pensions were a good thing. Your parents or whatever, pensions were not a bad thing to have. And you didn't have that. You didn't have that money, but you had the pension. And I feel the same way about how. And I don't call these things individual pensions or whatever. They're annuity payments issued by an insurance company, and that's what they are, but they function very similar to a pension, and with actually greater flexibility and control of the annuity itself than a pension would have.
Yeah, Jerry, we've seen some interesting studies that people are much happier when they are receiving checks in retirement than trying to live off their savings. So it certainly confirms everything you're saying. I'm curious. It sounds like you've struck a really strong partnership with Kiplinger's. Where are these self-advisor? If somebody's trying, if we're trying to find these self-directed advisors, where are they today? Are they, and where's the next generation going to listen? Is it if not Kiplinger's? I mean, are people going to be going to Snapchat as they start to get older and think about retirement? What do you think the new who will the next voice of authority be in this space?
Well, again, I started talking about our business model. Our original concept was to go direct to consumer and be that voice, and then go to what we call the institutional channel and find third-party advisors. We've sort of reversed that, and we're going to the institutional with the direct to consumer as being secondary. We're finding, or at least the strategy is to find them based on a relationship that they may have with, in the first instance, with a financial planning software firm. That's a logical place where they might be, they're doing planning, they have a relationship, we're an extension of planning, and so on. We could go to insurance companies. They obviously have trained agent advisors, but we believe the annuity should be open architecture, and we should have they should have the ability to compete. So and eventually, we think that robo advisors, et cetera, if we are going to be natural places to go. But for the moment, we're looking at that agent advisor to be our.
So Jerry, another big, I don't want to say elephant in the room, but another big topic, and that really coincides with the income annuity is inflation. I mean, a lot of there's a lot of concern on inflation, and and by the way, I'm playing devil's advocate here. The fact that the payouts are flat until the rest of until the rest of your life, basically, are somewhat counterintuitive to the typical inflation protection one would need. Again, what are your thoughts on the income annuity within the context of inflation?
So, water is a pretty important thing. And what makes water is H2O, and now I've told you everything I know about the science there. But oxygen and hydrogen operate quite differently. So annuity payments, we're a fan of fixed level payments, exactly to your point. But we know people want inflation. And so what do we add to the annuity payment, or how do we structure the annuity payments to basically hit that inflation? And to be honest, we say we're hitting inflation. We're targeting a fixed rate of increase. If we tried to tie everything to inflation, we'd only invest in TIPS bonds and so on. There's nothing really that correlates to inflation. So in complete candor, the client can target the fixed rate of increase in their payments. And if inflation is 18%, they can withdraw the cash if they need to, but the plan is not going to deliver that inflation, the true inflation protection. I think that's just too difficult.
And to your point, you could also, by having some sort of, income, you rely less on the remainder of your portfolio, and the remainder of your portfolio may potentially, kind of tackle that aspect of your overall retirement planning.
Yeah. And again, in all of this, we haven't talked about the impact. I mentioned taxes and the impact of fees, and fees on investments. Was working with somebody, and he said, I've got this advisor, and he's got this 4% rule, and I said, what are his fees? Oh, he says very low. And what I told him, I said, in order for you to deliver 4%, you got to earn 5%. You just made this guy your partner in your income. And so our view is we're not against fees. Fees are necessary. But if you can lower your fees against a portfolio, designed for income, you can do a great job in terms of delivering more, more income in the process. If you can do the same on taxes, if you can lower the tax on income, and by the way, this is asset allocation. The federal income tax return is based on taxation of income. So unless you're a genius, I don't know how you go from assets to the expected tax other than some rule of thumb. And so one of the things we did is we built in to our model the tax return. And what we discovered is, and the accountant didn't know it, it's one thing to talk about the taxation of a product. The other thing is to talk about the taxation of your entire account. And so there are ways of lowering fees and lowering taxes that, getting back to the inflation question, make it that much easier to hit a 2 or 3% number.
Yeah, well, interesting, Jerry. We've had a lot of discussion about inflation, not only on the show, but with some of our partners as well. It certainly is an issue that I think is coming more and more to the forefront. Whether it's temporary inflation, I guess we'll find out in another 3 to 6 months. So we're at the top of the time, I guess. Hey, Will, any questions or thoughts that you'd like to get on the table here?
No, other than I'm sure you're going to tell us at some point or direct on how someone can go look at this, whether it's through Kiplinger's or through your website. I'd like to check it out myself and play around with it. And also the one thing, I mean, we've talked about inflation, we've talked about a bunch of different things. The one thing, we don't have time to get into it now, but I think people often consider medical expense planning as well as part of this whole equation that we've been talking about. So I think that's on the forefront of folks' minds as well when they're talking about if they're going to live longer and they're going to outlive income. Definitely, there's a interplay there with the need for medical expense planning as well.
And that's a really good point.
Go ahead. Sorry, Bruno.
No,
please.
What I was going to say is that ties exactly with what Jerry said earlier on. If you have to, if you live past the age 90, just cut down your expenses. Well, it's feasible to say that, well, take one cruise instead of 2 cruises this year. But if we're talking about medical expenses, it's a different discussion. So, to Jerry's point, that's absolutely an unsatisfactory answer that needs to be planned for.
Yeah, and the other part is whether you're paying the expenses or paying the premium on a long-term care policy or whatever, or your estate planning. The worst thing to do is to do all this good stuff and not have the resources to keep the thing in force when you absolutely, need it. And whoever knows the statistics, there's a very, very high probability that in your 90s you're going to have significant medical or long-term care costs.
Yeah, well, certainly today's environment, boy, it's at everybody's forefront. What I think, Bruno, I think I saw the average life expectancy or something dropped like a year this year. Like it's what a terrible environment we're in. Mark, we've certainly talked about different strategies for coping with inflation that we know and that we can expect. I mean, what are your thoughts or final questions here for Jerry?
No, I think this is great. Obviously, trying to solve for an unpredictable timeline is very challenging. So it's an important process to put guarantees in place, and it's important to really kind of find the underlying assets and solutions that are in play to generate that income. So, Jerry, thank you very much.
Yeah, Ramsey.
So a couple things. One, Jerry, great to have you on the show. After all this time, fantastic. Bruno, thank you for doing a great job as guest hosts. The thing I will say about both of you, which I think is fantastic, is that you both come from an institutional background in this industry, and you both have demonstrated a real dedication to taking that industry knowledge, that industry insider knowledge, and infusing it into the work that you make available to consumers. So it's a real service to consumers. Thank you for that.
Thanks to you, Ramsey and Paul and Will and Mark.
Yeah, and Jerry, where should people go to either see the tool, read more about your, what you're offering? If I'm an institution and I want to work with you to send leads, what's the best way to see your tool and reach you?
Yeah, well, I've published 46 blogs on Kiplinger.com. So if you go to their wealth management section, and if you want to read all about it, working backwards or forwards, you'll learn about our views on a lot of things. The public-facing site is go to income.com. You'll see our planning tools. You'll see our annuity tools. You'll see another tool, and then in terms of our advisor-facing, right now it's for our internal direct-to-consumer, but we will be launching this as part of a outreach program to third-party advisors. So the tool you'll be able, and which has more capability, obviously, than the client-facing tools. But you'll get a sense of our planning by go to income.com.
Excellent. Bruno, last time we spoke, we talked about your book, which is great. We heard you on a podcast with our friends at Annuity Genius, I guess a couple weeks ago. What's going on in your world?
Well, I continue as you can see today. I think that one of the fascinating anecdote is that I opened the book, which is still on Amazon, so everyone can get it there. Lifetime Income to Retire with Strength, and I open up every single chapter with virtually everyone that has been on the guest on the show, and Jerry's no exception to that. So chapter 13 opens up with a quote from Jerry. So I of course invite you all to go see him.
Yeah, Jerry. Hey, Bruno, thanks for stepping in. I think did a great job as our co-host and or guest host for it. And Jerry, yeah, thanks for spending time. You're a legend among many people I've worked with in the annuity industry, friends from your AXA Equitable days and beyond. So thanks, and look forward to maybe having you back in a little while, either talking about your tool or the insights you're sharing on Kiplinger's. So Jerry, thanks for your time.
Great, thanks everybody. Appreciate it.
Thanks to you.
Thank you all.
Thank you. And thanks, everybody. And make sure to tune in again next week for another episode of That Annuity Show.
Thanks for listening. If you've enjoyed the show, please rate and recommend us on iTunes, Stitcher, Overcast, or wherever you get your podcasts. You can also get more information at thatannuityshow.com.